Welcome to Stockwatch. I'm Nader, and join me to unpack your stock-related questions today are Jean Pierre Verster from Protea Capital Management and Nader from Benguela Global Fund Managers. Be sure to send your questions through via email at stockwatch@bdtv.co.za or via X using the hashtag Stockwatch or via SMS to 41392. Thank you so much for your time, gents, and a very, very happy New Year. I don't know when I'm actually going to stop saying that, so bear with me, please. All right.
Yes, 15th of Jan.
15th, okay, that's tomorrow, that's tomorrow. All right. Well, gents, it is, trading has come back online. And actually, it was quite interesting looking at the JSE today. It seemed like it was trying to make some sort of rebound, but really failing at that. JP, I just want to start off with you. Are you sensing a little bit of nervousness in the market at this point?
Yes, Zanati, the market has entered 2025 with some nervousness, especially on the JSE. I mean, we had some issues with Tencent being put on a list, which obviously affected Naspers. We had the US 10-year yield getting closer and closer to 5%, which has made investors a bit nervous. It raises the cost of equity and cost of money. So that means a lot of people say, wow, 5% for US Treasuries as a dollar return that I can get for the next 10 years. That's not bad. Maybe I should sell my equities and rather invest into that. So outflows from our market, outflows from emerging markets, stronger dollar, weaker rand, all of that has been quite an unwelcome cocktail to see off 2025 with the retailers and the banks under significant pressure together with Naspers, yes.
Well, I mean, on the rand front, there was a sweetener on the cocktail because the rand went back to 18 rand 94. I mean, as much as you kind of want to celebrate, it's still like very close to that 19 rand level against the US dollar. Grant, what can you say of this? Of course, the equity market really ending off relatively flat, but seeing, I guess, significant gains on the rand today. Was it all the US?
Yeah, there was a little bit of digestion on the dollar move. I mean, the dollar's been an absolute wrecking ball across global currencies, and as that yield has moved out, it's putting pressure, and we know it puts pressure on emerging markets. Look at the rand. What happens when the rand weakens? The pressure comes through inflation. Suddenly our interest rate cuts are maybe in question. Oil has bounced quite a bit from its lows from December. So we've got question marks around the economic outlook. I mean, it's short-term in nature, so you don't want to start panicking or moving anything at this point, but it certainly does put some pressure and some risks that weren't on the table only a few short months ago around the outlook for SA Inc. You know, the banks, the financials, the retailers. It was looking pretty rosy. A rand above 19, oil bouncing, the interest rates not cut. Those things change the dynamic somewhat. So I think there is some nerves, there's some digestion. It is the 14th of Jan. One must be careful of making decisions at the start of the year because there's a lot of repositioning that takes place, and it may not be setting a trend for what's to come.
Yeah.
But yes, there's certainly a bit of nervousness at the moment.
Yeah. All right. Well, gents, let's get to some of the questions that have come through today. Of course, one of the big ones having been Reinet. Quite a long one here. Panel's view on Reinet's sale of its BAT holding. Actually, let me start off with that before I get into the essay. Your view on the sale of that BAT holding by Reinet. Was this actually expected, JP?
No, I don't think it was expected. We know that Reinet over the long term was following a strategy to diversify away from British American tobacco, but they've dribbled out. They've sold a little bit over December, as an example. Even before that, they sold smaller chunks, and they even borrowed some money against their BAT shares at one point in time when it acted as collateral. But it does seem like after British American tobacco shares did quite well over the last, say, 18 months, they had a bit of a bounce. That the Rupert family, the people who make the big decisions at Reinet, decided now's a good time to make quite a big switch and convert that BAT position into cash. So it's the London shares, that's why it's been placed in London, and it immediately increases the cash balances of Reinet quite substantially. And in the market, if you look at global markets overall around the globe, some might say they're looking more expensive than cheap. to all of a sudden go from almost a portfolio fully in equities to a portfolio with a decent chunk of cash all in one swoop is not necessarily a bad idea. So it was not expected, but I think it's quite a shrewd move.
Well, I mean, the comment from the viewer actually emphasizes your point that they've been trying to diversify away from BAT, where that holding was about 25% of assets now. Now 25% of assets initially was over 85%, and obviously saying that this was not due to the disposal of shares, but rather the non-BAT portion of its investments appreciating there. And then it goes on to say, but when they did sell some to finance the purchase of other investments, the price in sterling was 30% higher than present. Thus, if they hypothetically sold their holdings then and were able to make similar investments at the time, their asset value now would be a good few multiples more than present. Let's talk about that timing, Grant. Would it have been preferable for them to sell before this time, particularly where the BAT share is right now?
If only we'd all bought more NVIDIA at $50. You can only make the best decision you believe you can make at any given point in time. I don't think this is a bad time. This BATS is not a core holding for them anymore. Okay. I think they'll get this investment asset, this pension fund asset, if they spend it on that at a good moment in the UK. I think that industry is going through a lot of change, and they might actually get an attractive entry point to top up that holding if that's what they do with it. And then, as JP said, it'll be quite nice to have some cash at this point in time. There's a lot of opportunities and quite a bit of uncertainty, especially outside of the US. The US is this little haven of tranquility, and the rest of the world, I think there's a lot of opportunity. So I think it's a good enough decision. I'm not unhappy with what they've done.
So then, the last part of that question, would I be correct in seriously considering purchasing the share, Reinet, at this point, considering the opportunity that you are seeing, JP?
Well, it's got quite a heavy fee structure. That's the first thing. And Mr. Rupert himself has said it's not a vehicle to get rich. It's a vehicle to stay rich. So don't expect that Reinet will necessarily shoot the lights out, but it's a relatively safe investment if you look at the type of assets they do own, like Pension Corp, which Grant has mentioned has done very well for them in the UK long-term obligation market, where they buy these retirement obligations from other companies. So it's a decent portfolio, but I like operating companies that sometimes can shoot the lights out, rather than investment holding companies that diversify and chug along at a decent clip. But you might be able to pick some shares better than what you get when you buy a whole portfolio that someone else has chosen for you, which is quite interesting to say, because that's what we're in the business in. You know, people choose to invest in our funds, the portfolio that we choose. But I like to make those decisions rather than giving it out to someone else to make those decisions.
All right. Well, I mean, just on BAT's side then, and in terms of investor appetite there, Grant, do you think that this could shift the view of the trajectory of the company going forward, or does that stay intact, even though Reinet, one of the big shareholders, is gone?
I don't think it fundamentally changes the outlook. These guys have been stepping away from a big brother shareholder role for a long time, and so I don't think the company's worse off without them there. I mean, really, the challenges BAT faces are about the future of smoking. We all know the challenges, and the race to bring the next generation product portfolio online at a pace that offsets the decline in the old generation, you know, the traditional smoking. It does look like they're actually doing a pretty good job there, and I think as they gain some critical mass in that next gen, you know, the vaping and the heats and all that stuff, there's still some prospects for the company. It's not one that excites me. I think the growth is really under pressure, and I much prefer Philip Morris. But I think for the dividend and maybe sort of the rand hedge component, you could look at a BATS. But yeah, I think it just is. It gives you what it gives you. It's a generally a pretty steady, staid business.
All right, JP, this one is specifically for you. Let me get to it. Your view on Brazilian Nubank after your experience at Capitec.
Yes. So a lot of people compare Nubank to Capitec because it's a digital first bank.
Yeah.
Even more so than Capitec. I mean, Capitec has got a lot of branches. Nubank doesn't have branches. It's all based on an app on your phone and a credit card that effectively acts as a bank account. A very strong position in Brazil. Also has expanded into Colombia and Mexico. It is one of the 3 largest fintech companies in Latin America. Mercado Libre just pipped them the last month or so to become the biggest. And I like Nubank. The fact that they've built an ecosystem, so started with, like I say, a credit card, and that evolved into all kinds of other products. And the share price was down, I think it's about 20 or 25% in the last 3 months after a very strong run in the year and a half before that. So I do like Nubank still, and it got a bit too expensive up until 3 months ago. And now with that 20 to 25% cheaper, it's on my radar again. I do think it's an interesting opportunity, yes.
They're the ones that have an investment in Time Bank, right? And also, does that maybe boost your optimism for the company?
That's very small for them. So I can see that they maybe decided they're going to focus on Latin America. They saw the model that Time Bank was going to roll out in the Philippines, and they said, "Oh, let's take a small stake." But it's a passive stake; it's very small. So I wouldn't get too excited about Time Bank just because Nubank took a very small stake. But I do like Nubank because they have done what Time Bank is trying to do in the Philippines.
All right. Grant, is this one that you look at?
It's one I've started looking at, and you know, even though it's a small stake, as JP said, I think the exciting potential here is if they start to share IP. So there's certain things that TimeBank is doing that Nubank is still new to, and vice versa. And I think Nubank can actually show some interesting sort of strategy and insights to Time. So it's quite interesting from that point of view. I mean, I think they've got 100 million clients. It's been an incredibly fast growth story. There's only 1 or 2 big competitors in South America playing in that space, like Mercado Libre. And so I think it's an attractive opportunity. And yeah, as JP said, with a healthy pullback, maybe that should have been my stock pick tonight.
Yeah, it is January because a lot of people were on holiday. They spent their money on holiday and on hotels and the like during the festive season. There's a question on City Lodge. Of course, I'm quite excited to see what the numbers reveal when they do come out with their trading statements and results. Grant, your view on City Lodge at this point?
It's one I've struggled to get excited about. I've just felt their portfolio is a little bit old and tired, and it's not quite fit for purpose anymore. And I feel like they are very vulnerable to the Airbnb evolution. But you know, and also they have a decent amount of debt. Yeah, so I've struggled. I don't like it per se, and hopefully they prove me wrong. I think Sun International or even Southern Sun is a much better proposition in terms of the portfolio of assets. But we'll see. You know, it's not one for me. I would pass on that.
Okay, what about you, JP?
So I do think Southern Sun is probably a better hotel business, and they are exposed more to the leisure sector, to those people who take holidays, like you say, Zanati. City Lodge has got quite significant exposure to the business market and conferencing. And yeah, look, they've been through a traumatic rights issue after some BE debt that they guaranteed. And then that was linked to the share price. When the share price fell, it became a self-fulfilling prophecy. That's now a number of years ago. It was during COVID, but the dilution is still around. There's still like, I don't know, 8 times more shares in issue today than what there was in 2019. So that is hamstrung management. And yes, they need to invest more into their properties. So the thing about hotel business is it's all about your occupancies. And they haven't seen an uptick in occupancies. The last update last year, as far as I remember, they actually said it's going sideways to slightly down on a shorter rolling term basis. So that's disappointing. So I think it has a lot of potential. I'm not quite clear what can get those occupancies up. They probably need to do some clever things when it comes to marketing and bundling and partnering with other events organizers. It's got a lot of potential, but yes, it's not quite fulfilling its potential at the moment.
All right. Well, let's go into property growth point. Quite an interesting chart there, because of course we did see the buying that came with the interest rate cycle that has made a turn, but also the GNU. But looking like it's been under a little bit of pressure for the last few months. Grant, your thoughts on growth point?
So, of all the property stocks, this is one of those we've stayed away from, with its, principally because it had a larger office exposure than a lot of the other. The retail property space has thrived and office has struggled.
Yeah.
Even though they have an amazing asset in the V&A, it's not big enough to offset sort of some of the other challenges and the large amounts of debt. I still think it's a good business. I think they'll be fine long term. I just don't see the urgency to own this business. The yield is reasonably attractive. I think you could argue for owning some of it among a handful of portfolio stocks, but if I could only own one, I probably wouldn't choose Growthpoint at this stage in the property cycle.
JP, how much growth are you seeing in Growthpoint?
Yeah, my thoughts are similar to Grant's. I think they'll show anemic growth. Look, they've got the Victorian Alfred Waterfront as a significant asset, their biggest asset, and that's great. Yeah, if you look at the tourism boom in Cape Town, that must be doing very well. But then they have the rest of the portfolio, which unfortunately is not doing so well, and significant office space, as Grant has said. So yes, I still prefer the property companies listed in South Africa, but actually with their exposure to Eastern Europe.
Okay.
NEPI, and then Fortress with indirectly some exposure to NEPI still, even after that corporate action last year. So that has been, I think, a better bet, because Eastern Europe is still showing single-digit growth, but then you also get single-digit rand appreciation, and you put those two together, and you can get up to double-digit distribution growth every now and then. And a company like Growthpoint will struggle. Most South African retail real estate companies will struggle to show that. Some of them got very, very cheap just after COVID and have recovered nicely. But now that they've recovered, you're waiting for that significant growth in like-for-like turnover rents, positive reversions when contracts come up for renewal. And you're seeing spots of that, but with the low GDP growth, it's not really a great market for property still, in my opinion.
All right. Well, let's go into asset management. Coronation, is it a good investment, Grant?
Well, I have been in the bearish camp for a while on Coronation, but generally speaking, if you're bullish on markets, you should be bullish on asset managers.
Yeah.
More broadly, they should participate. I am quite bullish on the outlook in SA and globally, and Coro seems to be turning around its global flows. I think they're starting to stem the losses. They've struggled to grow the AUM. I think the value is deep enough that you can buy it. I think the yield is pretty attractive. I don't know the number offhand. I'm sure the dividend yield is around 8%, maybe more. So it's not an exciting business, but I think it's a good business, and I think they're getting themselves in shape, and they're managing to fend off some of the foreign competition on the global equity, asset management front. So I think that bodes well for the future. So I would look at it.
Okay. I mean, JP, would you say that maybe this is a relatively defensive one?
Yes, I would describe it as relatively defensive, very, very high yield. So on the one hand, they don't have the opportunity to reinvest the profits that they generate every year into the business. So they pay that out to shareholders, which is not necessarily a bad thing. And if you pull a total return graph of Coronation, you get quite a different picture versus just pulling a share price graph. And you would see that in the last year, there's been a big bounce in the return of Coronation, because they've effectively paid you 3 dividends in the last, call it 14, 15 months, because they paid that extra little dividend after they won the court case against SARS. And if you put that all back into the share price, it has returned a very nice return over the last year. But having done that now, I think it is trading closer to fair value in an environment where the net outflows is offset with some positive performance. If you look at how their funds have performed till the end of 2024, the numbers are becoming available now. Their funds have done better than average, so that's good. So they'll probably in the next interim result show a decent performance and a growing dividend again. But it is closer to fair value now after those significant dividends have been paid out in the last year and a bit.
All right. There's a question here on Premier Foods. The share price had a good upward trend towards the end of last year. Is it still a good buy at the current price, or should one wait for a pullback? Grant, and actually quite an interesting trend that we've seen with like all these counters that were recently listed from unbundlings.
Yeah, I mean, I think Premier's done really well since listing, and particularly in the last few months, as you said. I like the business, I like the management. I don't think it's very attractively priced here, so I'd probably wait for something of a pullback. You might find an opportunity. I know it's a similar space, it's not directly comparable. I think Tigers potentially offers a little more upside because they've got a little more, like almost Premier's running really well. You know, it's already operating well, whereas Tigers can do a lot to improve what they're doing. And I think you might see a little more opportunity there to drive some returns. So Premier, good business, but I'd probably wait on the sides at these levels.
Interestingly enough, I did have a technical analyst with me earlier on, and she was showing us the potential upside for Tiger Brands that had shown what you call a bottoming up pattern. On your side, JP, yes. Oh, I'm an expert now.
Hang on.
Yeah, write it down. JP, your thoughts on Premier Foods?
Also very similar to Grant. I think it's a high quality business, very good management. The management team have really fixed a lot of stuff that weren't quite efficient enough in that business. Some new bread factories coming online, has really won a lot of market share in rice, as an example. So a well-managed business, but now it is priced to show the quality of the business. So I agree with Grant. Also, it would not be my preference in the space. I'll throw another name of the food producers in there, and that is AVI. It's got a bit of a retail exposure as well, but at the current prices, I've got a preference for AVI, and then only the likes of Tiger Brands and Premier Foods.
All right. Well, gents, let us get to your stock picks for today. Grant, what are you choosing?
So my stock pick is one of those that never gets cheap, but it's always a great business. Capitec, that's my pick. It's had a decent pullback, close to, well, it's over 12%, 13%, somewhere around there. I think it remains fundamentally outstanding business with outstanding management and a lot of growth drivers that they are yet to pull. So they're moving into a lot of value-added services outside of the traditional core banking that are all high-margin businesses. And, I still think there's very exciting prospects. This is not a stock you're likely to get cheap unless there's some kind of COVID blowout or a GFC. So when you get a pullback, you should look at least look at starting to nibble on this kind of business.
Yeah, interesting, because I also saw that Bank of America also shared similar sentiments. JP, on your side, what are you hanging your hat on?
So similar theme of a company whose shares are not necessarily trading at a cheap level at the moment, but I do think it's a high quality company that's a growth company. And I would be surprised if you would ever get the shares very cheap unless there's a big, significant correction in markets overall. And that's Boxer. Also a recent listing, as you said, if you look at the recent listings, especially the unbundlings, they've done particularly well because these are not companies that decide to list where someone is selling shares necessarily because they think at that price they're going to make more money than the public. It's sort of almost like a forced listing.
Yeah.
So with Boxer having been unbundled out of Pick n Pay partially, you can now access it directly. If you look at the growth profile, both the historical growth, the future growth expected, the high returns on capital, it is up quite a bit from the IPO price. But I would love to wait till it gets cheap. But I think it's one of those that if you try to wait, you might wake up 10 years later and you didn't ever get an opportunity, and the share price is 7 times higher than where it was today. So not cheap, but a high quality company, and that's the one I'm going for tonight, Boxer.
All right. Well, thank you so much for your time and for your analysis today, gents. Much appreciated. To our viewers, there are 2 questions that I didn't answer, multi-choice and prospects for PGM producers. But Simon is back with Stockwatch tomorrow, so I'm sure he will be going through those. That is all for tonight's Stockwatch, though, thanks to our guest, Jean Pierre Verster from Protea Capital Management and Grant Nader from Benguela Global Fund Managers. Coming up, the close. Stay watching.